Hello guys, welcome to our video. On today's video, it's me Wardah Fahira and my partner Naomi Romondang. We will explain to you the matter related to return on invested capital. Without further ado, let's get into the video. Analysis of company performance demands joint analysis, where we assess one measure relative to another. The relation between income and invested capital, referred to as return on invested capital, ROIC, or return on investment, ROI, is probably the most widely recognized measure of company performance. It allows us to compare companies on their success with invested capital. It also allows us to assess a company's return relative to its capital investment risk, and we can compare the return on invested capital to returns of alternative investment. We use return on invested capital in several areas of our analysis. First, measuring managerial effectiveness. Second, measuring level of profitability. And last, measuring of planning and control. First, measuring managerial effectiveness. Management is responsible for a company's business activities. It makes financing, investing, and operating decisions. It selects actions, plans strategies, and executes plans. Return on invested capital, especially when computed over intervals of a year or longer, is a relevant measure of a company's managerial effectiveness. Next is measuring profitability. Return on invested capital is an important indicator of a company's long-term financial strength. It uses key summary measures from both the income statement and the balance sheet to assess profitability. These profitability measures have several advantages over other long-term measures of financial strength or solvency that rely on only balance sheet items. It can effectively convey the return on invested capital from varying perspectives of different financing contributors. And last is measure for planning and control. Return on invested capital serves an important role in planning, budgeting, coordinating, evaluating, and controlling business activities. This return is composed of the returns achieved by company segments or divisions. These segment returns are also made up of the returns achieved by individual product lines, projects, and other components. A well-managed company exercises control over returns achieved by each of its profit centers and rewards its manager on these results. Components of return on invested capital. First, net operating profit after taxes or NOPAT. NOPAT is after-tax operating cash generated by company and available for all investors. For either financial analysis or valuation by investors, companies are often compared using their net income. Net income is the bottom line of the company's income statement. Net income is important, but it doesn't always reflect the true performance of company's operations or the effectiveness of its managers. A better measure is NOPAT, which standardizes the measurement because it is the amount of profit a company generates if it has no debt and holds no financial assets. You can more accurately compare two companies with differing amounts of debt and disparate asset base using NOPAT instead of net income. Second is invested capital. Invested capital is the investment made in a business firm during its life by shareholders and debt holders. The shareholders invest in the business stock, while the debt holders invest in either in a short or long-term debt, including bonds. Then how to calculate ROIC? Here's the example. X Corporation has $30,000 on its income statement as its EBIT or in earnings before interest and taxes, and its marginal tax rate is 28%. The firms have $35,000 in short-term and long-term debt and $65,000 in equity financing. It has $1,000 in retained earnings, $2,000 from cash from financing, and $2,000 from cash from investing. First, we have to calculate NOPAT. The formula to calculate a NOPAT is EBIT multiplied by 1 minus T, where T is the firm's marginal tax rate. So the calculation must be $30,000 multiplied by 1 minus 28% or 0.28, and the result is $21,600. Next, we have to calculate invested capital. Invested capital equals to current liabilities plus long-term debt plus common stock plus retained earnings plus cash from financing plus cash from investing. So invested capital equals to $35,000 plus $65,000 plus $1,000 plus $2,000 plus $2,000, and the result is $105,000. And last step, we have to calculate ROIC. ROIC equals to NOPAT divided by invested capitals. So $21,600 divided by $105,000 equals to 0.206 and equals to 20.6%.
Next is analyzing return on net operating assets. Disaggregating return on net operating assets. Recall that the return on net operating assets, or RNOA, is computed as below. We can disaggregate this return into meaningful components relative to sales. The disaggregation of return on net operating assets is shown from the picture. The NOPAT to sales relation is called net operating profit margin, or simply NOPAT margin, and measures a company's operating profitability relative to sales. The sales to NOA relation is called the net operating asset turnover, or simply NOA turnover, and measures a company's effectiveness in generating sales from net operating assets. This picture right here describes the major components determining return on net operating assets. The first level of this analysis focuses on the interaction of NOPAT margin and NOA turnover. The second level of analysis highlights other important factors determining profit margin and asset turnover. Next, effect of operating leverage. Net operating assets, or NOA, are reduced by increases in operating liabilities, thus increasing net operating asset turnover, provided that the increase in operating liabilities does not affect NOPAT. RNOA is also increased. The operating liability effect is seen in this alternate decomposition of RNOA, where OA is operating assets and OLAF, or average operating liabilities, or average NOA, is the operating liability leverage ratio. Since OLAF is a positive number, increasing OLAF increases RNOA. Next, disaggregation of profit margin. Operating profit margin, or OPM, is defined as below. The operating profit margin is a function of the per unit selling price of the product or service compared with the per unit cost of bringing that product or service to market and servicing customer needs after the sale. For analysis purposes, it is useful to disaggregate pre-tax profit margin, or PM, into this component. Disaggregation of asset turnover. The standard measure of asset turnover in determining return on assets is asset turnover measures the intensity with which companies utilize assets. The most relevant measure of asset utilization is sales, since sales are essential to profits. In general, turnover rates reflect the relative productivity of assets, that is, the level of sales volume that we derive from each dollar invested in a particular asset. There are also accounts receivable turnover, inventory turnover, accounts payable turnover, and net operating working capital turnover. Next, analyzing return on common equity. Return on common shareholders' equity, or ROCE, or simply return on common equity, is of great interest to the shareholders of the company. Return on common shareholders' equity serves a key role in equity valuation. Recall the accounting-based stock valuation formula is below, where V is company value, PV is book value of stockholders' equity, and I is net income, and K is cost of equity capital. And also this formula can simplify as pictured below. And next, disaggregating the return on common equity. We can disaggregate return on common shareholders' equity to obtain ROCE equal to RNOA plus LEV multiplied by spread, or ROCE equal to adjusted profit margin multiplied by asset turnover multiplied by leverage, where the second term, or LEV multiplied by spread, is the effect of financial leverage. The first component of the financial leverage effect is the degree of financial leverage, or LEV, measured by the relative amounts of net financial obligations and stockholders' equity used by the company to finance its net operating assets. The second component is the spread, the return on net operating assets, or RNOA, less the net financial return, or NFR, where NFR is the average net return on financial liabilities and assets. And next, assessing growth in common equity. First, equity growth rate. We can assess the common equity growth rate of a company through earnings retention. This analysis emphasizes equity growth without resort to external financing. To assess equity growth, we assume that earnings retention and a constant dividend pay out over time. The equity growth rate is computed as this picture. And second, sustainable equity growth rate. The sustainable equity growth rate, or simply sustainable equity growth, recognizes that internal growth for a company depends on both earnings retention and the return earned on the earnings retained. Specifically, the sustainable equity growth rate is computed as this picture. Okay guys, that's all for the video. Sorry for our mistakes. Thank you for watching. Bye.